Well, folks, I spent $32,000 plus on a stock here today. We're going to talk about what stock that is, why I went ahead and did that. It's a rather big move. Even for me, that's a pretty dang big move for a day. There's got to be a pretty special opportunity there. So we'll speak about that opportunity at the beginning of this video, okay? Then we're going to get into Tesla. Tesla stock's up 15% plus in the past month. Why does the stock keep going up? People have looked at the numbers recently and they're like, what's there to be excited about here? We're going to discuss. It's very important everybody understands what's going on there at Tesla, because we're seeing a phenomenon go on very similar to what we saw coming out of the tech bubble back after the 2001 to it was actually 2000, the stock market crash started. 2000 to 2002 stock market crash, and coming out of that, I want to show you some important things in regards to that. Oil is down to $65 a barrel. 65 bucks. What the flip is going on in regards to oil? I want to talk about that in this video because I do think it's an important subject to speak about. PayPal, we got big news in regards to PayPal. Very, very excited about that. So we'll speak about that in this video, what it means for PayPal stock. But before we get into that, I got to address something. Listen, I recorded a video this morning on the reaction channel. I said good morning to my family, and I went, good morning my kids, good morning my wife, and I went straight to record this video right after, okay? I just had woken up, and everybody was making fun of me for the way I looked. They said I was smoking on the Jack Jackson. They're all making fun of me. So I have one thing to say. I would love to see what y'all freaks look like when you wake up, okay? I'm sure you all look like supermodels when you wake up, don't ya? You're just gorgeous. You're just a perfect 10. You're a dime when you wake up, aren't you? I'm sure you are, okay? So anyways, guys, I appreciate you joining me, and thank you, everybody that smashes that thumbs up button and is subscribed here. Regardless if I'm wide awake like I am now, ready to record a video, or whether I'm like half asleep and I'm trying to keep my eyes open, okay? I appreciate y'all being here. And by the way, I left my 20s years ago because I'm about to turn 35. And, some people leave their 20s and they still want to party. Other people, they leave their 20s and they still like to listen to conference calls till 2 and 3 in the morning. That's what I like to do, okay? So I stay up kind of late, all right? Listen, guys, if you didn't get to see this video yet, make sure you check out this one when this video is over. 16 years of stock market advice in 52 minutes. I've seen so much positive commentary in regards to that. So many people have been helped out tremendously by that video. It has 34,000 views so far. Definitely a video you'll want to check out if you're taking stock market investing serious, okay? So, listen. There's a lot of stocks in this market that I want to buy right now. And I mean, it's a long dang list. My potential buys watch list is the longest it's been in probably since 2022, just to be quite frank, okay? But there's one stock I bought $32,000 plus up here today, and that stock is Elf on a shelf. Yes, Elf Cosmetics, Elf Beauty. The juggernaut that is Elf, one of the I would say by far and away the most well-run cosmetics company in the entire market for the past number of years. Absolutely extraordinary company. The stock has been absolutely crashing here recently, and I went out there and I placed a pretty big order today. 300 shares I bought. I got those shares at $108.88 there. It was $32,664 in my Ally account here today. I keep a bunch of money in savings over there in Ally, and I moved some of that money over, and I said, we gotta deploy some of this on a stock like Elf here today, okay? Now, why? Why today? Why go buy this stock, right? It's an absolute falling knife. There's no debating that. Elf stock is a falling knife. You want the definition of a fallen knife? Elf is a falling knife, okay? First off, everybody throw a pity party for me. I'm down to my last 1,400% gain on this stock. It is so sad. But listen, in all seriousness, this is since late July. The stock has been cut in half since late July. Late July wasn't even that long ago. And the stock is already cut in half? What? What do we have going on here? From the stock was, 220-ish, almost 220, right? To 110 here today. I bought those shares at, 108 or whatever? What? Oh, right, 108, yeah, 108.88. What's going on here? What went south in regards to Elf on a Shelf, and why am I buying the stock here today? Well, here's what went south, okay? The company had been consistently growing 70% plus clips for quarters in a row, many quarters in a row. 78% growth, 76%, 76%, 84%, 71%. So people got very accustomed to kind of the 70 to 80% range of growth for 5 straight quarters, right? And then you slow that way down to 49%. Now, 49% is amazing growth. But when you're accustomed to these sorts of growth rates, sometimes it can be very hard on a stock. This is the same exact phenomenon we're seeing in two other very popular stocks right now, right? There's, in terms of a major growth slowdown, right, from like these incredibly ridiculous rates to, let's call it still unbelievable, right? Like, give me a break. How many companies would switch places with Elf? Like just about every other company in the stock market. Like literally, if we said the thousands of companies in the stock market, who would trade places with Elf in regards to revenue growth? Almost every single other company. Almost, literally. They're a top 1%, if not the top 1% of the 1%. Special, right? But this is the same phenomenon that's going on with two other very popular stocks right now, right? That are facing growth slowdown. What are those stocks? One, the most popular stock in the entire stock market for the past couple of years. What is it? nvidia. nvidia is starting to face the slowing growth cycle, just like an Elf, right? And what have we seen? nvidia stock's obviously down considerably from the top it reached just a few months ago, right? There's another extremely popular stock that is facing the same exact thing right now. Not nearly as popular as nvidia, but it's still a very popular stock, especially with retail investors, that's facing a very similar growth slowdown. What is that company? Celsius Holdings, Celsius Beverage, right? Another perfect example. Celsius growth rates are still very impressive recently, but they're nowhere close to the rate they were growing. So when you go through that growth slowdown, people get freaked out. And next thing you know, you see selling on selling on selling in regards to that stock, and it causes absolutely historic moves down where you're like an Elf, like drops 50% in a matter of a few months. What? Cut in half that quick? Happens quick, right? So here's the deal, okay? We spoke about the growth rate, 78%, 76%, 76%, 84%, 71%, now down to 49%. Here's what people believe is about to happen here, okay? We believe we're going to go full cycle on this. Meaning, essentially, we just had our 49% quarter. A lot of people are believing the next quarter is going to be in the 30s, as this quarter was back then, 33%. Then they believe we're going to go down to the mid-20s, as this quarter was 26%. Then down to 13%, 10% range, right? That is what they are convinced and believe is going to happen over the next 4 quarters. And so we're going to continue to see major, not like, like major decelerations of growth, right? Like if we fell all the way to these ranges of the 10 to 13% revenue growth range, and you're used to growing 70, 80%, that's like the end of the world, right? That's like the end of the world. Now, keep in mind, 10 to 13% revenue growth would still be very respectable for most companies. But when you've been growing 70, 80%, it's not acceptable. It's like horrible, right? So that's the way people view it. And this is why you see every growth investor that was in the stock piling out as fast as they can. They want no piece of it, right? And it's just selling pressure and selling pressure. And it's just relentless in regards to the stock, right? And you got to keep in mind, a lot of people aren't really focused on where Elf is 3 years from now, 5 years from now, 7 years from now. They're focused on where they think Elf is going to be 3, 5, and 7 months from now, 3, 5, and 7 weeks from now, 3, 5, and 7 days from now. That's what they're focused on, right? I'm thinking about Elf over the next 3, 5, 7 years. These other folks are not thinking about that. They're thinking about the short-term stuff, and the short-term is not exciting in regards to Elf because you got deceleration of growth, which means they want no piece of the stock right now. And you not only have deceleration of growth, but you also have a company that still isn't really focused on profitability yet. So you don't really have the profitability story in terms of like their earnings per share is going to go flying this year. I think it can start to go flying next year, but it's not going to this year, right? So you have a company not super focused on profits. Meanwhile, you got major decelerations of growth, right? And that causes people to get very freaked out and they want out of the stock. No, check this out. This is fascinating. This looks at analyst estimates for the next few quarters in regards to stock. Is it not very similar to what I showed you right here, right? Look at this. Analysts are expecting the next quarter to be 34%. Look at, they did 33% there, right? Then down to 21%, right? And here they were at 26%. Then down to 17%, 16%, and Elf was kind of 13%, 10%. So maybe a little more bullish for analysts on this. But isn't that insane? They're basically expecting a whole round trip here. We're going to go through the whole round trip in regards to Elf over the next few quarters, right? Now, me as an investor, does this scare me at all? No. 0% scared. And I'm going to show you exactly why here in just a moment. I'm going to take you through an ultra bearish case in regards to ELF and what happens with the stock price. I'm going to take you through a bearish case. I'm going to take you through a base case, a bull case, and an ultra bull case in regards to ELF right now, and all the projections and numbers I have and kind of how I'm looking at this. But as far as me being scared, no. Because you got to understand, in regards to ELF, we're talking about growth. The debate is not, is this company going to go bankrupt? No. Is the debate around like, oh, the stock's super expensive? Not anymore. There used to be a debate, 3 months ago, 6 months ago, but after the stock fell 50%, you can't even make a debate around valuation anymore. So we don't have a debate around valuation. We don't have a debate about our growth rate's going to go negative. That's not a discussion. Bankruptcy is not a discussion. None of those are discussions, right? The only thing we're debating here, right? There's no debate about has a brand fallen off? No. The only debate is, what are the growth rates looking like for the next few quarters? Is it 30%, 20%, 10%, 40%, 50%? Where are we at here, right? And then what about 2025? Because that's what everybody's really going to be focused on, 2025. Are we going to grow revenue 15%, 20%, 25%, 35%? That's what the debate is, okay? It's very important everybody understands that. That's why I'm not scared. If the debate was around other things like, oh, I think the brand fell off, oh, then I'm concerned. Bankruptcy, oh, then I'm concerned, right? Revenue's going negative, then I'm concerned. Deceleration of growth, not concerned. That's not something as a long-term investor freaks me out, right? Because I'm very understanding. ELF's not going to grow revenue 70, 80% all the time. Like these people, you want to talk about people smoking on the Jack Jackson going down the planet. You want to talk about that? You want to talk about that? Let's talk about that. You expect this company to keep growing revenue 70, 80% for all of eternity? What? What are we talking about here? You're crazy. They're not going to keep growing revenue 70, 80%. Anybody that's factoring that into their numbers is on the jack. I'm just telling you, man. That's crazy talk. Everybody that should be invested in ELF should not expect this company to keep growing 70. It's not practical. It's not, I guess everything's possible, but it's not very possible either. That's ridiculous. Ridiculous, okay? So, let's go ahead. Let's run through some different scenarios here. We'll start very bearish. I mean, as bearish can get. We're going to do an ultra bear case for ELF. Keep in mind, whenever I think about my ultra bear case and my ultra bull case, very low probabilities those happen, right? Very low probability. But we have to still run the numbers and projections. Here's. Oh, by the way, real quick here, just want to show you this before we get into those projections. 26 2-year forward P on the stock. With 10 plus years of growth ahead, that's where I was speaking about earlier. It's not a question of valuation anymore. That's crazy, right? I mean, this is just, we're getting into some silly pricing here. All right, here's my ultra bearish case for ELF. Ooh. In my ultra bearish case, I have ELF only doing 12% revenue growth on average, 2025 through 2028. This would be an unmitigated disaster for ELF with all the retail expansion they have, with all the sell-through opportunity, with all the ability they have to raise price over the next 4 years if they want to, right? Because they have so much pricing power in the market for the next, at least 5-10 years here. Additionally, with the international expansion opportunity, the Notorium brand and how much expansion there is there with that brand that is growing rapidly right now. If they grew 12% on average a year from 2025 to 2028, complete failure of the company. It would be embarrassing. But I like to run my ultra bearish case in an embarrassing scenario. Additionally, they couldn't even get net income to grow faster than revenue in this scenario. Their net income growth would be the same exact as their revenue growth. 12%, talk about a disaster. Net income margins under 10% in this scenario. How disastrous is that? 9% net income margins? Talk about embarrassing. Oh my gosh. So if you've got a company that's growing top line and bottom line in the cosmetics industry at 12%, you would command a P somewhere between about 25 and 35 on that stock, which in 2028 would put the stock somewhere between $77 and $107, which means my compounding annual growth rate would be negative. I would have lost money in the stock. If you bought the stock today, you would have lost money over the next few years, right? This is insanely unrealistic. I mean, incredibly unrealistic, but it's a possibility, right? As everything, I would call this like less than a 2% probability. Probably, I'd put it right around a 1% range, which is the same as my ultra bullish case. Is probably right around 1%. In my bear case, those scenarios are probably more on the 10 to 15% probabilities. As far as my bull case, my bear case, and then my base case, I think, I look at that and I think there'll be somewhere around those numbers. That's probably like a 60% plus probability in regards to that. Here's my bear case in regards to ELF. If you want to put together a somewhat realistic bear case for ELF, here's the somewhat realistic bear case, okay? Also not very probable, in my opinion, but this is that scenario. This would be ELF growing on an average of 15% revenue per year over the next 4 years, right? Net income growth of about 20%, so just, a little outstripping revenue growth. Net income margins of 11% come 2028, which ELF should be a lot more of a mature company. 11% net income margins would be very disappointing for this company, just to be quite frank. I'm sure they want to eventually get to a place where net income margins are in the 15% above area, but this is a bearish case, right? Now, if you had a company growing 15% top line on average per year, 20% bottom line on average per year, you're going to command somewhere between a 30 and a 40 PE ratio on that stock, which in this bear case, I'm still going to make money in ELF stock over the next few years, right? And this will put the stock somewhere between about $121 and about $162 come 2028, which on the low end would be a compounded annual growth rate of about 2%, which would be pretty sad, but hey, it's still money, right? It's still making money. And on the high side, there'd be about a compounded annual growth rate of about 10%, which, not very exciting, but it's still money. It's still making money, right? So that's my bear case. That's more realistic. If you want to be bearish around ELF, those are the numbers to run. That's the more realistic, kind of negative numbers. And this is a company I know very well. I would say, of companies I know, this is certainly in the top 50 of companies that I can kind of see what they're most likely to do, what roughly as far as revenue growth and those sorts of things, okay? Here's my base case for ELF Cosmetics. Here's the deal. I think they're going to be able to grow revenue 25% on average. Now, some years they're going to grow faster than this. Some years they'll grow a little less fast than that. Okay, that is something to keep in mind. I like to kind of think about what's the average I'm expecting for this company for the coming years. And I expect 25% on average growth over this next 4 years, okay? Net income growth, I have that outstripping by about 10 percentage points there, and they're going to be able to, that's where they have the most leverage, in my opinion, in regards to the business for the next 4 or 5 years, is really getting that net income up, that earnings per share up. So I've been doing about 35% growth when it comes to net income. They'd put their net income margins right around 12%, which still isn't very good. I think this company should be able to get to 15% plus net income margins by 2028. But anyways, I wanted to be kind of conservative, even my base case, only 12%. Now, if you're growing 25% on average top line, 35% bottom line, you're going to command at least a 2x or a 3x or 4x higher P ratio than the market in general. Market in general, kind of think of a 20 range. So a 40 to 70 P is very realistic if you're growing at these sorts of rates on average per year, which in this scenario puts ELF stock in 2028 somewhere around about $259 to maybe $453, which gives you a compound annual growth rate on the low end of about 24%, compound annual growth rate on the high end of about 42%. And I mean, it's hard not to buy ELF stock here today. It's very, very difficult not to buy ELF stock when I look at, this sort of compounding annual growth rates with this stock that I'm projecting out here. And the company only getting net income margins of 12%, that's pretty dang good. Here's my bull case for ELF here, okay? My bull case for ELF is revenue growth of around 30% per year for 2025 through 2028. Now, I have them still outstripping when it comes to net income by about 10 full percentage points, so doing about 40% net income growth. And that would put net income margin still right around 12% for the company. Now, if you're growing 30% top line, 40% bottom line, you're going to command at least a 45 PE on the low end and about a 75 or above on the high end. So in my bull case, this puts the stock somewhere between about 337 and about 561 in 2028, which would give me a compounding annual growth rate on the low end of about 32% and a compounding annual growth rate on the high end of around 50%, right? So do I expect that scenario to play out? No. Would I love that scenario to play out? Yes. Would I be shocked if they pulled a scenario like this off? Given how unbelievably great the company has performed over the past 5 years, that actually wouldn't shock me. Like, if this stock in 2028 is $330 or $500, I wouldn't be shocked. It's already shocked me already in regards to how well this company's done over the past 5-6 years. So this is just like, I'm not expecting that, but would I be surprised? No, I wouldn't be surprised. Here's my ultra bullish case. Ultra bullish case has them doing revenue growth on average of 40% a year, right? That would put them at about $4.5 billion of revenue in 2025. Now, how could they get there? They would have to continue, their sell-through would have to continue to pick up. They would have to raise price quite a bit over the next few years. And they honestly do have the room to raise price if they want, because they're still the cheap kids on the block, especially considering the quality of their product. So they could pull it off, right? So you have more sell-through, you have higher prices. Each year they raise price, 5-10%, something like that, right? And additionally, you have a lot more products in stores, which honestly they should, because their sell-through is so insane. They sell better than anybody else out there. Their consumption's crazy, right? Additionally, you get into new retailers that you're not already in, right? Additionally, international expansion. Additionally, the Notorium brand becomes super famous. Additionally, they probably pick up some other brands over the next 4 or 5 years, right? Could I see 40% revenue growth on average in that sort of scenario? That's possible, right? But it's not super probable in my opinion. Net income growth outstrips quite considerably the revenue growth, so they do about 70% on average net income growth, which would put the net income margins in this ultra bullish case at 20%, which would be phenomenal. Really, really great if the company could get there, right? Keep in mind the gross margin of this company 70% plus. So, it's possible. Not super probable, but it's possible. In this sort of scenario, you would command easily a 60 to 100 PE if you're growing on average 40% a year on top line and 70% on bottom line, which then would put the stock somewhere around about $977 to about $1,628, which would mean the stock would once again 10x. It'd go from $100 to $1,000 plus, right? And it'd be another 10x scenario in regards to ELF. You'd see the market cap go from $6 billion to 60 billion, something like that, and the company would then be seen as a cosmetics giant. ELF today is not seen as a cosmetics giant. It is seen as a company that is extremely fast growth, that is on the way to becoming a cosmetics giant. That's the way you got to look at ELF today. ELF is not a cosmetics giant today. They're on their way to becoming a cosmetics giant, right? Kind of the way you might have looked at Tesla a few years ago. You looked at Tesla and you said, they're not a big manufacturer of autos, but they're on the path to become a big manufacturer of autos and start selling millions of cars a year, right? And so that's kind of the way I would think about ELF right now. And this would be obviously a scenario where people would look at this company, 2028, and they'd be like, oh, they're a giant now. Like, they're the big dogs in the industry. They're a big dog, right? And yeah, if you start commanding a $60 billion market cap on you, yeah, you're a big dog then at that point in time, right? Now, this would give me a compound annual growth rate on the low end of about 72%, on the high end of about 96%. So that would be very, very bullish. But I'm not baking that into my numbers, right? Looking at this scenario, this is what I think is probable, and that gives me a phenomenal return, man. Phenomenal return. If I can feel like even in my base case, I can get a compound annual growth rate over 20%, I won, man. It's one thing if you expect a compound annual growth rate of 20% plus on your ultra bullish case, but on your base case, if you're over there, this is what I'm talking about, baby. I like it. I like it a whole lot. Now, here's a question for you. Serious question. How many companies do you feel great holding in a recession, in inflationary times, in deflationary times, in a strong economy, and in a kangaroo economy? Kangaroo economy is kind of similar to the economy we've been in for a while now, where it's just, you get data points and it's down and it's up and it's down and it's up. It's hard to say it's a recession, but it's hard to say it's a strong economy. I feel like we've been in a kangaroo economy for quite a while, right? How many companies? I really can't think of many. There's a very small list of companies you would actually feel legitimately comfortable holding in all those scenarios. Even somebody like a McDonald's, I would not feel comfortable holding in all those different scenarios, right? And the reason is, if you're in a very high inflationary time for McDonald's, it's not exactly the best thing, because you see wages go up quite considerably, which then starts to hit their profits big time. Transportation of all those buns around and all that meat and everything, right, starts to go up considerably in a high inflationary time. All of a sudden, the cost of doing business goes up considerably, and so that's something that could actually hurt a McDonald's or a Coca-Cola or some of those names, right? ELF's one of the very few companies that, regardless, they're well positioned. for anything. And they've proved it, right? They proved it in 2020. They proved it in 2022 and 2023, right? They've proved it in every sort of scenario we've really had thrown at us, because we've really seen all these different scenarios. We've seen a strong, like if you think about the last 5-6 years, right? We saw a strong economy during the last 5 or 6 years. We saw a recession early in the past 5-6 years, right? The government didn't call it that, but we did. We've seen a deflation economy. That was kind of 2020, right? We actually saw massive deflation in regards to tons of different commodities out there, right? We obviously saw massive inflation. And then we've honestly been in a kangaroo economy for a while. So we've already seen all these in the past 5 or 6 years. And look at how well ELF stock's done in the past 5 to 6 years. It's one of the best stocks literally in the entire stock market. So that makes me feel pretty darn great about this one, right? Now here's kind of the way I think about the stock. Under $120, silly. It's silly, man. It's silly that this stock could be under 120. Silly. And that's where I got it today, under 110, right? If the stock goes under 100, it's plain stupid. Like, what are we doing here? Okay, if it goes under 100, big questions about if that even happens. But if it does, stupid. If it goes under 80, it's brainless. Completely brainless. If investors sell the stock all the way under 80, brainless move on their parts, and they're going to regret that like it's nobody's business. I don't know if that's really going to happen, but if you had a scenario where, let's say, market's weak, plus ELF's next quarter growth numbers are not that great with a guidance that's not that great, plus tax loss harvesting in the fourth quarter, it's always a potential to go under 100 or maybe even under 80 if you had all those scenarios play out. I think I'm a little doubtful of it, and it would be just brainless if that does happen. And that would be the most historic buying opportunity for ELF we've probably seen since back in the day when I was getting in the stock. That would be crazy if that played out. But right now, silly pricing in regards to that, right? Now, Tesla. What's going on with Tesla? 15% in the past month? Why does the stock just keep going up? Like, what is it going on here with Tesla, right? So, you got to understand something very important. This is I'm going to take you all the way back to the tech bubble and kind of what we saw there. Because if you look at Tesla, right, we had the blow off top in 2021. The stock went to over $400 a share, right? Peak excitement, growth was insane, interest rates were on the floor, and then everything changed, right? No more hype, no more excitement, no more FOMO. Interest rates went up massively, which destroyed countless companies that deal more in, if you have to take out a loan, interest rates, right? The highest interest rates we've had in several decades. If you all of a sudden have the highest interest rates in several decades, right, it's going to devastate the auto industry, right? It's going to devastate existing home sales. It's going to destroy furniture sales and those sorts of things. And if you look at existing home sales, you see that, right? You're starting to look at a lot of these auto companies and their stocks aren't looking so good and their sales aren't looking so good, right? Obviously, you've seen what has happened with Tesla. You know, look at an RH type stock, right? And a lot of these furniture related companies. It's not been good. And then, so, the stock has that blow off top, 400 plus. And then it has a tech bubble type crash, right? All the way down to around $100 a share. And I got some shares back around that time. I'll show you a screenshot in just a moment, right? That's a tech bubble type crash. It is 70+% historic crash for even Tesla stock, which is a very volatile stock. Even by Tesla standards, that was crazy, right? And now basically what has transpired since the end of 2022, beginning of 2023, is what I call a multi-year recovery. You don't, when a stock like Tesla falls that hard and you have interest rates go up as high as they have, right? Fed funds rate where it's at, you don't just recover right away. You don't go right from 100 right back to 400. It's not the way it works. It's many years of recovery. And you have to be prepared for that. It's going to be many, many years, right? This, by the way, shows you the shares I got back then. And congrats to anybody that was buying Tesla early 2023. You know, that was the most interesting time to be a buyer of Tesla, probably since I was buying Tesla back in like 2019 here, $16.97, $15, $14, $13, $12, right? But I got those shares right back there in January, $106 a share, 145 shares. There was a pretty special opportunity, right? And that was after the huge epic sell-off, right? But this looks back at Amazon in the, kind of before the tech bubble went pop and then after, right? And so Amazon downtrended for about 1.5 to 2 years straight, right? And then it bottoms and it starts coming back to life. Very nice, right? And ultimately, at the end of the day, it took Amazon 9 years to get back to where it used to be. 9 years. Now, do I expect it to take Tesla 9 years? So let's say 2030, right? Old highs are in 2021. So let's say all the way out to 2030 to reach new highs. I don't think that's super possible, but it is a possibility, right? Let's say we had a big major unemployment cycle, a big recession in either 2025 or 2026, right? What does that mean for auto sales in that environment, even if interest rates are going down? Well, shoot. I mean, if people are scared about losing their jobs, they don't want to take any risk out there and buying new cars or homes or things like that, it's still not going to be good for Tesla sales in that particular time, right? And so, therefore, that could be a tough spell to go through for the entire stock market, including Tesla stock, right? Which then it would have to recover out of that scenario. So let's say there's a scenario where Tesla goes up to 250 here in the short term, which is actually a possibility in the short term, right? And then all of a sudden 2025 hits, big recession, right? Or 2026, and it's like, oh, it's ugly. All of a sudden Tesla goes from 250 back down to 150, 175 or something like that. Is that possible? That's possible, right? And then it starts to have to climb back to 250. And then we can climb to 300, and then we can climb back to 400. And by that time, you could be all the way out to 2028 or 2029 or maybe even 2030 by that time, right? In terms of getting back above 400 again. So that's a possibility, right? And it is something we all have to consider. The one thing I'll say about that is Tesla's valuation, although it got very high, it wasn't as ridiculous as a lot of those tech companies back in the tech bubble days. Remember, a lot of those tech bubble companies back in those days, they didn't really have any real business model. Tesla's, last year did what? A little under, if I recall, this is off the top of my head, I think it was a little under $100 billion of revenue, right? Somewhere around there, roughly. Listen, no companies back in the tech bubble days was doing $100 billion of revenue or anywhere remotely close. The companies weren't even, most of them weren't even doing $1 billion of revenue, never mind $100 billion. So that was a different time frame. So I don't really like to say, could I see it taking 7 years or something like that for Tesla to get back? So let's say it takes out that 2028 high, or it takes out that old high of 400 plus in 2028 or 2027. I think that's a possibility, right? Something to consider there. You got to understand, when the new mass market vehicle hits in the market, there's going to be a whole ramp time there. It's going to hurt profitability in the short term. It's going to be a whole process to go through. Elon's talking about ramping that vehicle in 2025. We don't know. Like, Elon's time sometimes a little above. It might be 2026. That vehicle actually starts ramping 2027, right? And so it really starts to show up in the profit numbers more 2027, 2028. I don't know. Those are just all things to consider as far as that go. Robotaxi, you can't really draw any real numbers from that in the short term meaning the next year or two. 5 years from now, 10 years from now, it's a whole different story. Robotaxi revenues, I think, will be real, and I think they'll be substantial 5 years out or 10 years out. 1 year out, 2 year out, it's going to be minuscule, and I think that could actually be a lost leader in the short term, because I think ultimately Elon's going to want to price significantly under Uber and Lyft at the particular time to just take market share. And so I think that will actually hurt Tesla's profitability during that short-term time period. So I don't know, man. You look at it and it's like, at the end of the day, Tesla's in a multi-year recovery, but it doesn't go straight back up to 400, especially when you're doing as many big things as Tesla's doing and you're spending as aggressively as this company's going to be spending, right? It's very costly. You want to do all this stuff. You want to do an Optimus robot. You want to do a robotaxi network. You want to have a cheap mass market vehicle in the market. It's expensive to do all those things, right? So that hurts short-term profitability, which hurts your stock in the short term at least, right? So, but the way I look at Tesla at the end of the day is 2022 through 2023, we're in the storm. It was clear about that, right? It was just getting worse, and it was getting worse, and it was getting worse, and it was just negativity, and we know what it was, right? And that was the storm of those 2 years. 2024 is a year I look at Tesla and I say, we're kind of in the in-between time where you're starting to see the sun come out. You're still getting storm clouds. You're still getting rained on a bit, but you see the sun and it's coming, and it's like, it's a very exciting time because you see the sun coming out, right? After you've been through this big storm. And the way I look at it in 2025 and beyond is it's sunny skies ahead for Tesla in 2025 and beyond. So it's kind of done a big full circle situation, kind of goes back to like Elf and what we were talking about in terms of that stock going full circle. This is a very similar phenomenon with Tesla where it was all sunny days, right? and we went into all dark days. And now we're at this moment where it's kind of been dark days still in 2024, but you see the sun, it's right there and it's about to come out, and you're about to get past the storm. And then 2025 and beyond for this company, ultimately, it's back to the sunny skies again. So that's going to be phenomenal in terms of that. Now, oil's down to $65. What the heck is going on here in regards to oil price? I think that's something we got to talk about. Listen, nothing's adding up here. Nothing's adding up. Look at this. Look at this. U.S. crude oil inventories fell by 2.79 million barrels for the week ending September. What? 2.79 million barrels? Inventories fell? Following a significant 7.4 million barrel decline the previous week. These aren't small numbers, folks. These are large numbers. 2.7 million barrels, 7.4 million barrels. Now, when you hear something like that, that should mean great news in regards to oil price going up, right? That's like the best news. Inventories falling? That's phenomenal. That means oil price is going up. And yet that's not happening. Nothing makes sense. The Saudis' cost of doing business in regards to oil keeps going up. Doesn't make sense. The fact that oil is trading at 65 doesn't make sense. No, not at all. I don't see enough people talking about this. I don't see anybody honestly talking about this, but they should be talking about this, right? And I spoke about this particular way of kind of thinking about it in a video maybe last week or the week before, because I kind of thought about it like, okay, oil's pricing in recession, but oil's a dumb asset. Oil's a clueless asset. There's some assets that are you kind of look at and they're kind of like tells on what's going to happen with the economy or not happen with the economy. Copper can be one of those many times, right? Oil's not. Oil's a clueless asset. Oil hit an all-time high during the great financial crisis, okay? During the great financial crisis, July 2008. This is as clueless of a clueless asset as you can imagine, right? But it's a very manipulated asset, an extremely manipulated asset. Do you want to come say hi, buddy? You want to come say hi to the camera? No? No. Okay. You don't have to. It's up to you. So it's a manipulated asset. Nothing makes sense here in regards to this.
I'm scared.
Oh, yeah? What are you doing?
Scared.
Okay. Do you want to say hi to the camera or not really? You can't be in here while I'm recording. Unless you want to be part of the video. What do you want to do? So moral of the story is oil is insanely manipulated, as a lot of commodities are, honestly. And don't be surprised if come November, oil price starts spiking back up. Don't be surprised at all, okay? PayPal, big news in regards to PayPal here, okay? PayPal received this email today. Said at the beginning of the year, this is kind of an email laid out by Alex Chris. Said at the beginning of the year, I laid out PayPal's bold vision for the future of commerce, a future that's more personalized and rewarding than ever. Our teams are moving with urgency, relentlessly innovating, and focused on execution to deliver this vision. PayPal is a go-to payment option for hundreds of millions of customers' online purchases, and now we're expanding in-store, so our customers have a richer and more rewarding experience everywhere they shop. I'm excited to share that starting this week, we're launching a national marketing campaign to show consumers how to shop and earn rewards with PayPal everywhere. This is our largest brand investment to date and includes an ad spot featuring actor, comedian, and producer Will Ferrell. Now, I watched this ad. I thought it was great. Will Ferrell, so, it catches your attention first off, right? You watch the ad, it definitely, even if you don't care anything about PayPal, it's going to catch your attention. A lot of people obviously love Will Ferrell, so I think that's always good to associate yourself with somebody that people love, right? It's kind of a funny ad as well, and it definitely does a great job, in my opinion, of showing PayPal used in stores and kind of using the debit card in stores, which you can get like 5% cash back on items through that debit card, which I think, when you talk about 5%, cash back, now you're really talking, right? Because most people think in regards to cash back, usually 1 to 3%. You talk about 5%, that's a big number there. So I'll say I'm feeling better than ever in regards to PayPal. For sure better than ever, man. No doubt about that. Very excited. I can't wait to see these ads placed everywhere because I'm sure they'll be out there. If I was PayPal, I'd run ads heavy right after the election's over. Run ads heavy November, December, holiday shopping season, right? I think that would be brilliant. Ad rates, I think the next 30 to 60 days, you're going to have to pay through the roof in regards to ad rates because of the election, right? But after we kind of get through this time, I think November, December, run ads like crazy, okay? Alrighty, guys, appreciate you joining me as always. Thank you so much for being here. Once again, if you didn't get to see that video yet, 16 years of stock market advice in 52 minutes from last week, check that one out. And if you already got to check that out and you want to see my new workshop on stocks to buy, how to position your portfolio for 2025, then click the pinned comment down there. We send that over via email or via text. It's a free video. Much love and have a great day.